What should we expect after such a great up year in the stock market? Every year, I like to roast the Wall Street analysts who hope they'll be correct in their stock market performance predictions for the next year, in this case, 2024. Well, how well did they do at predicting 2022 and 2023? Not very good, as you can see here for 2022. And if we look at 2023, again, not very good. There were a few that were fairly close, but mostly they got it really wrong. Let me explain one of the reasons why. Assuming that because the S&P has historically returned about 8 to 10% per year, as you can see here, and we had an outsized upside this year of 24%, this thinking's extremely flawed. This thinking assumes world events and the economy will operate as it has for the past 100 years. Most likely wrong. So let's get back to reality and look at what our current metrics are indicating for the health of the equity, bond, gold, and crypto markets. So if we look back over the past week, you can see we had a very, very healthy rally going into Friday. And then I think some investors decided, whoops, I've got one day to take my tax losses, and they sold. They sold big time. This was a pretty big drop on Friday. And you can see for at least the higher risk equities, small caps, and ARK Invest, they ended the week slightly down, while everything else ended slightly up. What about over the past month? Well, this is a very, very healthy appetite for risk. You can see the pullback on Friday here, but in general, equities were up very nicely for the past month. And what about over the past year? Well, you can see we ended the year up big time. The S&P ended up 24.29%. That's the one you'll hear the most about. But everything else ended very, very nicely up for the year. This is a very healthy appetite for risk after the 2022 that we'd all like to forget. And how does this show up in the bottom dynamics? Well, interesting look here. You can see we've had a very, very nice rally here with a slight pullback on Friday. And what happened over the last couple of days of the week is the bottom confirmation signal, you can see, has been falling here as the confidence level, the risk confidence level, has been rising rapidly. And you can see that the bottom forming indicator during that same period is shooting higher. If I were going to base a prediction just on this chart, I'd say we're going lower next week. Now, the hesitancy I have is this is the last few days of the year when tax loss selling comes into play. So the question is, next week, will investors continue to sell, or will people jump in and say, hey, this is an opportunity. Equities have pulled back. I'm going to jump in and buy now. I really wouldn't want to make a prediction based on this last 3 days of the year. So I'm not going to. Let's see how next week plays out. But based on these indicators alone, if I were going to make a prediction, I'd say we're going lower next week. But who knows? And if we look at risk versus opportunity, I mean, these look fabulous except for the little bit of an upturn here in risk acceleration because of the sell-off over the last couple of days of the year. But you can see that risk, the red line, is plummeting. It's down here below 40. Risk acceleration, even though it's moving higher, is still just at 10. And the opportunity level is at a very healthy level here. So this looks really good. And what about equity versus safety? Well, equity versus safety, we couldn't have ended the year in a better appetite for risk. And let's take a look at each of these components to see what I mean. So if we take a look at the NASDAQ 100, you can see we had kind of a breather here. Now, you've heard me talk about that in my previous videos, but look at what it's been doing every week since. It's been moving up in the rankings. And what about small caps? Well, small caps were right up here in the number 2 position, only outshined by very long duration Treasuries, EDV. And then last week, small caps moved up to the number 1 position while EDV pulled back to number 2. This is a very healthy looking risk appetite. And if you want to layer on top of that, that the S&P 500 is now ahead of the Dow, that's even better. So this looks really, really great from an equity perspective. And what about cash? So if we throw cash in there, you can see that cash is down here right near the bottom, exactly where I love to see it. So this looks very, very healthy. And what about safe haven assets, U.S. government treasuries? Well, if we look at treasuries, we already looked at cash. You can see that all the safest treasuries are down here near the bottom where you'd like to see them. And the longest duration treasuries, EDV and TLT, are up here. This is a very healthy appetite for long bonds. And hopefully the rally that started several weeks or maybe months ago will continue into the next year. So how does all of this show up in the buying and selling pressure? Well, interestingly enough, you can see that equities pulled back on Friday, as we mentioned earlier. You can see it in all of these charts. The Dow was almost flat, but everything else pulled back. But what happened to the buying pressure, this solid gray line? Well, you can see the solid gray line went higher in almost every single case here while the market pulled back. This tells me investors were buying into the dip. Now, hopefully this bodes well going into next week. We'll have to wait and see. And what about small caps? Same picture. You can see the fall off here on Thursday and Friday and the buying pressure shooting higher. So buyers were stepping in and buying into this dip. This looks very, very healthy. And what about sector rankings? Well, if we take a look at sector rankings, last week we had Bitcoin and innovation right up here at the top, semiconductors and technology all up here at the top. We had cash way down here, consumer discretionary up here, and you can see the healthy relationship for government treasuries. This looks great. Well, what about this week? Well, we still have Bitcoin and innovation right here at the top. Treasuries improved a little bit here. Long bonds moved up a bit, and cash moved down. This really couldn't look better. Consumer discretionary pulled back a bit here. The NASDAQ 100 pulled back a bit here, but this in general looks very, very healthy. And what if we look at sector rank acceleration? Remember, these tend to kind of point where things are moving rather than where they've been. So this is a shorter view. Well, last week we had innovation and semiconductors right up here at the top, long treasuries up near the top, and this looked very healthy. Cash way down here at the bottom, consumer discretionary here, consumer staples here. Well, if we fast forward to this week, you can see that innovation has fallen back. Technology stocks has pulled back. Treasuries have dropped a little bit here. Consumer discretionary dropped. Consumer staples moved a notch higher, and cash moved up a little bit. This isn't disastrous, but it's not moving in the right direction. And that's kind of indicated by the pullbacks we had at the end of the last week on Thursday and Friday, both in equities and, as you'll see, in treasuries. Speaking of treasuries, how do they look? Well, if we take a look at treasuries, you can see what happened here. We had a pullback. Tax loss selling would be my guess. There was buying into the dip and then a sell-off going into the end of the week. So this was kind of a flat to nowhere week for treasuries, I think mostly because of tax loss selling. And if we look back over the past month, you can see we have a very healthy appetite for risk in treasuries. Longest duration treasuries, EDV finishing up 11.49% for the month. These are equity returns, not treasury returns. So this is looking very, very good. And what if we look year to date or over the past year? So you can see that there's been one heck of a rally here in long treasuries in both of these, even though they finished out the year slightly minus. This is very healthy. Hopefully we'll see this continue going into next year. And how does this show up in the buying and selling pressure? Well, if we take a look at the buying and selling pressure, interesting, unlike equities where the buying pressure shot up as the sellers stepped in, you can see that here, at least for the longer duration bonds, you can see the pullback here on Friday. And you can see that the selling pressure shot up as sellers came into the market. Now, for short duration treasuries, you can see they're still on a very nice rally here, and the buying pressure is still well above the selling pressure. And what about the yield curve? Well, boy, if you look at the yield curve, we've really come a long way here. You can see that long rates are right about where they were a year ago. The light blue line is a year ago. The solid darker blue line is current. And long bonds have come down in yield quite a bit from where they were just a month ago. Now, at the short end, we're just about where we were a year ago. So this is starting to look very, very good. Hopefully sometime next year we'll see this uninvert, but we're not there yet. We're still about 38 basis points inverted. And what do the markets think about what the Fed is going to do? Well, if we take a look at the Fed rate monitoring tool, it's clear that 82% of the market thinks that rates are going to stay put in January when the Fed meets. And there's a small but growing feeling that the Fed will actually lower rates by 0.25%. And what if we go out and look at March of next year, of 2024? Well, you can see that now there's a much bigger contingent here saying that, hey, the Fed by then is going to lower by 0.25%. And there's a growing contingent that says, you know what, they might lower by 0.5% by then. What if we go out to May? Well, if we take a look at May, you can see that there's no idea here. There's no concept here that rates will be where they are today. There's no blue line here. But you can see that there's a very strong possibility that the Fed will lower by at least 0.5%. And if we go into June, yeah, you get the picture, right? There's a very strong market feeling that rates will be much lower by mid-year next year than they are right now. And if that in fact happens, bonds will do very well, especially the long bonds. And what about gold? Well, yep, those gold miners are having quite a ride here. You can see that we had a big rally followed by a pullback, and we're going up again. You can see that buyers are stepping in and buying into gold going into the end of the year. Even though the price pulled back here, there's clear buying on the dip. So I don't know what's driving it, but we'll have to wait and see how this turns out. An interesting picture for Bitcoin. You can see we've had one heck of a rally here, but over the last several days, or maybe even longer than a week, Bitcoin has been pulling back. And you can see that the selling pressure, this orange line, is shooting straight up here. So I don't know if this is people taking their money off the table because they've made a huge profit on these over the last several months, maybe in anticipation of the SEC decision that we're supposed to hear about in January. Maybe there's fear that won't come in like everybody expects, and then Bitcoin will sell off. Really don't know what's driving this, but it could be any number of those things. I've mentioned in some of my previous videos that to be an investor, you have to take the long view. What does that mean? Well, it means that you don't sell a particular investment until you don't believe in the future prospects of the company anymore. In other words, you don't sell it just because it went up, 10, 11, 12%, 20% and take your profit. You don't sell it because you think it's overvalued. If the company has bright future prospects, you should really hang on to it, especially if you're in a taxable account where you're going to get hit with taxes by selling. In my video, Should Warren Buy Tesla? A Question of Value, I talk about how my father-in-law gave me great advice about how to determine when to sell the stock of a company. He said, invest in the business of the company and don't sell the stock until you don't believe in the business anymore. Notice he didn't say to sell it if it became overvalued or you had a big profit in the stock. And look, if you want some proof, here are the current returns of the companies he journaled into my son's UGMA account for college. Most of you would kill to get these kinds of returns. On that note, I hope you all have a very, very happy New Year. Until next week, I'm Calvin Rose, And thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here written in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips but the sun is stronger. Pour it out if I'm being honest. It's just not everything you promised. Running down, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true.